So for anybody who's tuning in these first early seconds, thank you for joining us. We're going to be talking about the forgotten tax benefits of real estate, and we'll be taking some Q&A. Let me make sure we're set up here and we're good in the Facebook group. Are we not live on the Facebook group right now? Oh no, we are live. There's just a slight delay.
That makes sense.
Yeah, okay, cool. Yeah, no, okay. All right, just want to make sure we're all systems a go. What the hell? Oh wow, I'm okay. So I'm live on my face. Okay, no, here we are. We're good. We're good. All right, everybody who's decided to bear with those 48 seconds of mayhem here.
Our technological blunder.
Yeah, I'm gonna hit everybody with the everyone. We're taking questions. All right, everybody. Thanks for tuning in. I see we have a few people tuned in right now. What we're going to be doing this evening, this is Taxes in Bourbon. We're going to be talking about the forgotten tax benefits of real estate. And then we're going to be taking some questions from the audience. So if you do have questions, if you are on Facebook right now, or you are on watching this live on YouTube, go ahead and drop your questions in the comment section. And we're going to go ahead and start taking them in a few minutes. Before we get started, here's what I'm drinking. This is Taxes and Bourbon. So we got Horse Soldier. This is actually 123.9 proof, so it's pretty hefty. I'm gonna go ahead and probably maybe finish this off today. Justin, what do you got?
So I've got this guy Templeton Rye 6 year. It's pretty good. I was telling Tom before we jumped on, it had the nice pop. It goes.
Oh, boom! Yeah, mine didn't have it. No, actually, before we went live, I had the Four Roses, but the cork was stuck in the bottle.
Cork off the bottle.
Yeah, so I wasn't gonna fix that tonight. So I'm gonna finish off this Horse Soldier. Shout out to Mike Turner who sent me the bottle. Thanks, Mike.
That's great. And let us know too, like if you're joining us with some bourbon for the Bourbon and Taxes. What do you got on your end?
Yeah. Mike in the comment section drop what type of bourbon of choice tonight. We got the Horse Soldier and Justin. I just forgot Justin's name again.
Actually, I don't even Templeton. Like it just says that it's from some small town, but I don't even know where I guess Templeton's probably got to be in Kentucky, right, or Tennessee. I can never keep that straight.
I have no idea, no clue. All right, so everybody, we're going to be diving in just 1 second here. If you do have questions, drop them in the chat box, in the comment section, and we're going to go ahead and be taking them. All right, so one thing I've been on a campaign recently. To prove to everybody that real estate has a lot of tax benefits, even when you're not using reps or the short-term rental loophole. In fact, when you zoom out and you look at real estate investing as a strategy over decades, okay, and not just years, not over the short term, but over decades, what you'll find is that the real estate professional status and short-term rental loophole, while really powerful tools to have in your tool belt, and if you can qualify them for them, you should absolutely use them. But they're just icing on the cake. And, it really is just icing on the cake. Justin, what do you have to say about that?
Yeah, absolutely. I mean, we bridge this topic with a lot of our clients where, they have the goal of going for something like the real estate professional status or the short-term rental loophole, but sometimes it's just not always viable. It doesn't always fit in their situation. Right. So, you can tell a lot of people would be kind of disappointed or whatnot and thinking, oh, okay, well, then there's nothing here for me. But once we expand on the situation a little bit, like Tom said, you kind of look more on the long term. When you start looking at, say, like 3, 5, and 7 years, a lot of the benefits are still there. It's just, you've got to look at it from a different perspective, from a different angle. And sometimes there's not quite as much of that, like just immediate gratification. There might be some delayed gratification, but as like a long-term investment strategy, it's still super advantageous.
Yeah, absolutely. So we're going to go through real quick what those benefits are. And then, like I said, we're going to be taking questions. So if you just joined, I see a lot of people joining right now. Go ahead, drop your questions in the comment section if you're on Facebook, or go ahead. I think on YouTube there's like a side thing you could drop them on. I don't know. I haven't been on live on YouTube for a while, but here we are. All right. So the first benefit of investing in real estate without the real estate professional status is tax advantage income. So I'm going to break that down for you real quick. I'm going to give you an example. I'll kick it over to Justin for him to add anything he wants to add, and we'll go from there. All right. So this recent revelation came to me when we were at PIMDCon, a conference for doctors. There's a lot of high income earners there, and what I demonstrated, what I showed to everybody during my talk is that let's say you want to make $55,000 extra, and I just pulling this number out of a hat, and I think I pulled the number out of the hat for the sake of the presentation there too. So if you are in the 37% tax bracket and you're a high income earner, maybe through a job or through a business, if you go ahead and maybe you take on some extra patients or clients or whatever, extra business, what have you, or maybe you work some extra shifts, then you put in some extra hours, then what's going to happen is at the federal level alone, that $55,000 that you just generated is going to be, you're going to pay $20,350 in tax. It kind of hurts, right? But let's just say you had a rental property or multiple rental properties, however you want to look at it. Now, let's say that those rental properties generated $100,000 in revenue or rental income, gross rental income. Now you're going to operate the property. So you're going to have operating expenses. You're going to have things like utilities, maintenance, repairs, professional fees, property management fees, perhaps property taxes. Let's say that amounts to about 45%. So 45% expense ratio, $45,000. Now you're going to be left with $55,000 of quote unquote. So that's net operating income, right? But now let's say, but thanks to real estate, what real estate has a non-cash expense called depreciation. Depreciation reduces your taxable income despite the fact you might have actually generated positive cash flow. So again, let's just recap where we are right now. You generated $100,000 of rental income. You had $45,000 of operating expenses, and these are expenses that you actually had to pay to third parties. All right, but now let's say that you have a $60,000 depreciation expense. Let's keep it nice and easy. Right now, it's you're going to have $5,000. You're going to have a $5,000 tax loss. So what does this mean? This means that despite the fact that you put $55,000 into your pocket, tax-free or tax advantage, you now have you're going to tell the IRS that you have a loss of $5,000. Okay, that's the first benefit. All right. Again, if you are a high income earner, you're in high tax brackets, you could be paying up to if you generate $55,000 of earnings, or in other businesses, net income in other businesses, you're typically going to pay the taxes on that. And if you're at the 37% tax bracket, that's $20,350 in taxes. But if you generate that through tax advantage income, aka rental income or other tax advantage sources, you could generate that $55,000 tax free thanks to depreciation.
Yep, exactly. And really, even at the other end of the spectrum, if say you're not like 37% tax bracket, you're at that higher income earner or something, and you're in like the 22% tax bracket, kind of right, so like married filing joint, that 22% bracket starts just shy of 90,000. So for most people in that scenario, like what Tom was saying, if you worked a little bit extra, you earned like more W-2 income, and you're going into the 22% tax bracket, well, and then all the earnings that you're going to generate are going to be, you're basically keeping 78 cents on the dollar in that situation, just from the federal side. Not to mention, if you're in that kind of tax bracket, you're also what a lot of people don't really notice as much, or at least try not to pay as much attention to, is the fact that you also in that situation have an extra chunk that's coming out for Social Security and Medicare, which is 7.65%. So like, even if you're watching this, you're listening to this and thinking like, oh, well, I'm not a 37% tax bracket person, so it doesn't have as much impact on me. I would say it really has like a pretty significant impact on you too, even if you're in like a 22%, because really what we're talking about, that's 29.65%. That's almost 30% right there. So, right. So you're the other big advantage with the rental income is that even if you're in a situation where the depreciation doesn't wipe out all of the rental income, and you have, say, $3,000 of taxable rental income, right there, just in and of itself, you're getting a benefit too, because the rental income is not subject to self-employment taxes, or i.e. FICA taxes like Social Security and Medicare. So, in that situation, you could look at it as, from one vein, like just saving 7.65% even from the fact that you're generating it from rental income. So, really, like, I mean, two opposite ends of the spectrum there on like income earners, but it's, hugely advantageous to both for similar and different reasons at the same time.
Absolutely. Absolutely. Across the board, no matter what tax bracket you're in, if you're able to generate tax advantage income through rental real estate, you're putting yourself in a much better position. And over time, if you, again, take the long zoom out, take the long view, decades, if you could build a portfolio that's generating tax advantage income for you, you're putting yourself in a much better position. So that's just the first one. So having said that, if you just joined, we are taking questions. We're going to pause for a second. We're going to take some questions. We're going to be talking about the forgotten tax benefits of real estate throughout this Taxes and Bourbon. If you don't know what Taxes and Bourbon is, basically once a month we go live on Facebook and we drink some bourbon. I got some bourbon here. Justin's got some bourbon. Brandon sometimes generally joins us, but he's out sick today, so he's not with us. But we're gonna go ahead and take some questions. So the first question that we had was, the first part got cut off, but this is the punchline of the question. But it was, I'm getting an Airbnb. I'm getting into Airbnb rentals in the Philippines. I'm a dual citizen. Can I claim rental losses to offset my W-2 income? Depreciation, bonus depreciation, short-term rental loophole losses. My Airbnb has below 14 days stay. I'm a U.S. citizen. Okay. So here's how this works. Let's break this down. Okay. So this is a short-term rental loophole question. Okay. To qualify for the short-term rental loophole, you must have an average period of customer use of 7 days or less. Okay. Or 30 days or less if you provide like hotel-like services to your guests, but 7 days or less is typically what we see. And then you must materially participate in your short-term rentals. There's 3 tests. The first test is 3 tests that are relevant. Okay, there's 7 total, but 3 that are relevant to most taxpayers. And that's, you spend more than 500 hours on the activity. Very challenging to do on short-term rentals, but it can be done. It's just challenging. You spend more than 100 hours on your short-term rental, and no one else spends more time than you. Or another way to phrase that is, you spend more than 100 hours and more than anybody else. That's probably the most popular test for the short-term rental loophole. And then the third one is you do substantially everything, which more or less means you're a one-person show. So let's break this down step by step. You're a dual citizen. Can you offset W-2 income? The short answer to that question is yes, right? The short answer to that question is yes, if you meet the criteria we just met. The one challenging part is the bonus depreciation, right? Right. Correct me if I'm wrong, but if you have foreign property, and the Philippines is foreign property as far as I'm aware, you're not going to be eligible for bonus depreciation.
Yeah, that's right. If you have property in foreign countries, like foreign jurisdictions, at least for the U.S. tax purposes, for like the U.S. tax return, there's a different depreciation system that you have to use called the alternative depreciation system. And it does not, and when it comes to foreign properties, it doesn't allow you to use bonus depreciation on the ADS. So, you could use the loophole, like Tom was saying, mechanically, but your losses are quite literally mostly going to come from operating losses, if you have losses at all.
Yeah, absolutely. So it is possible, but you might be limited there. All right, so we're going to take another question from the Facebook group. Again, if you just joined, go ahead, drop your questions in the chat box. We're going to go ahead, or excuse me, in the comment section if you're on Facebook, or if you're on YouTube, that like streaming section. You know what I'm talking about. All right, so we're going to go ahead and take this one. Lazy 1031 exchange. If I sell a property and I have capital gains, not sure how I see buying into a syndication, receiving bonus depreciation, passive losses to offset capital gains. I thought only capital losses can offset capital gains. Am I confused? Okay, the question gets truncated here. Am I confused or missing something? Justin, you want to take that one?
Yeah, sure, exactly. So there's like some concepts kind of being minced a little bit here. So when you have like, there's restrictions on capital losses as far as like like how much you can use those to say like offset W-2 income. Those are restricted. And you're right, capital losses can offset capital gains. But what's kind of interesting here is there's really 2 different code sections that are coming into play, and there's 2 different tax forms that are coming into play. So it's A bit of an overgeneralization to say that we can use like current rental losses to offset the capital gains on the sale. But really, what's actually mechanically happening on your tax return is if you have a property sale that registers a large amount of capital gains, they will be capital gains, but the key that's making this really useful is that those capital gains are passive because they were related to the sale of rental property, and that rental property is what's being deemed as passive. That means that you have passive income. Now we know that there's restrictions, passive losses as far as what you can do with them. You need something like reps or the short-term rental loophole to be able to actually use passive losses, unless you already have passive income. If you have passive income, then you are going to be allowed to use passive losses to offset just your total AGI, is really a better way to look at it. So I know that's why I say it's an overgeneralization when people say you can offset these capital gains that you're experiencing with like these ordinary losses from like a cost segregation study. But it's a little bit more complicated because what's actually happening is the fact that you have passive income is enabling you to actually claim your passive losses as allowed losses as opposed to being suspended losses. So what will end up happening is you'll see your capital gains are actually going to flow through like your Schedule D. That's going to wind up landing on the 1040 on that very first page where it shows capital gain income. Well, capital gain income does increase your AGI, but separately, you're going to have losses from real estate, which are going to flow from the Schedule E, where your rentals are. And what's going to allow it to flow up onto the front page, that first page of the 1040, is the fact that you have passive income, which is enabling the passive losses to actually make it up to the 1040. And then those losses are going to reduce your AGI. And you would see that front page where you have like W-2 income and then like other business income, capital gains, and everything adding up to AGI. So hopefully that's not like too confusing, but it's more of that. It's because there's two concepts at play there. We're not just dealing with capital gains. We're also dealing with the fact that we have passive income and passive losses.
So kind of like the bottom line there is like basically the gains from the sale of your rental real estate are passive. And if you have passive losses from the syndicate, they could offset each other, right?
Yeah,
okay,
exactly.
All right, so we're gonna go ahead. We're gonna take a few more questions. We do have somebody. We're gonna take one from the YouTube channel. Brian, thanks for tuning in. I'm not gonna post this one on here, show this one, but he says just getting to my first STR in a few weeks, and then can I self-manage in 2024, take advantage of the short-term rental loophole, then give it to a property manager in 2025, but in 2025 buy a second property, self-manage it, take advantage of the short-term rental loophole, then give that to a PM and keep repeating? I mean, the short answer to this question is yes, but it's a little bit maybe a little bit more complicated than that. Okay, so let's break this down. Again, the short answer to your question is yes. You can buy a short-term rental in a few weeks, place in the service, and self-manage in 2024. Take advantage of the short-term rental loophole, and then you can give it to a property manager in 2025. However, what I'd recommend, it's advisable to make sure you rent it out like thoroughly as a short-term rental in 2024. And what I mean by that is don't just place in the service at the end of the year. It doesn't sound like that's the case for you. It sounds like you're buying it soon and you'll place in the service in 2024. But you want to make sure that you're truly operating it through and through like a bona fide short-term rental so that if you're ever audited by the IRS, they're not going to try to figure out some ways, and there are some ways they could do it, try to frame it as you're just using it as a tax shelter. Right? You want to make sure it's bona fide. And then the next year, you could theoretically do it again. However, what I would also suggest, and we don't have evidence of this yet, we've not seen this yet, if there's a pattern of you doing this, and Justin, I'd love to get your opinion because this is pure speculation right now. If there's a pattern of you operating it as a short-term rental and then flipping it over to a property manager and making it go passive the next year, potentially the IRS could make the argument that you're just doing it for the tax. Like the first way that the IRS could attack this is that they could say you're only spending these hours for the pure purpose of getting around the passive activity loss rules. And there's actually a section in the regulations that says that. So, Justin, what's your opinion on this?
Yeah, I mean, I'm less concerned about materially participating 1 year and then not materially participating the second year. But I would be more concerned with it going from a short-term rental to a long-term rental in a really quick turnaround, because that really, I think that more heavily questions intent than just like material participation does per se. I think that you could have a decent argument for, like, I was managing this the first year and gave it the college try, and it was just too much for me, or with it being a remote property, is really difficult to manage. So I need to bring in a property manager or something like that to make sure that it was on the up and up and cash flowing well and stuff like that. So I think there's a lot of legitimate reasons why you might have flip it over to property manager, but definitely if you rented it out for like 2 months as a short-term rental and then flipped it to a long-term rental, in January or something like that, I think that would be a little bit questionable, because they could question your intent, in that situation. And there, like Tom said, like, there's not court case evidence of this yet, but there's a lot of other tax concepts that get argued fairly often where intention is called into question.
Right.
So I think it's possible.
Right, Brian. So what my bottom line is on this is that you'll probably be fine. It's given the fact pattern that you mentioned in your question. I would put a little asterisk on that to let you know that there is a little hair there that, it's not 100% foolproof, I guess you could say. But right now, there's no evidence to say that you couldn't do it the way you described.
Also, just from a practicality standpoint, and I make this recommendation to clients fairly often, is that, it's kind of difficult if you close on a short-term rental in like the fourth quarter. I mean, here we are, it's October 4th when we're recording this, and there's a lot of people trying to squeeze this in before the end of the year, and they're going to find themselves in the position where it's kind of hard to get that 100 hours minimum in only like 3 months or even 2 months time. Well, if you could imagine it, you very well could be in a situation like that next year in 2024 also. So, if you are successful in pulling it off this year, great. But it can be very useful to go ahead and continue like doing your material participation in 2024, because if your plan is to kind of rinse and repeat, so to speak, with the strategy, it could be great if you already have a short-term rental that you're, operating and it's in place and you're getting material participation on it. Because if you buy a second short-term rental in 2024 and maybe you do it in September or even like November, and you're really struggling to get those hours in again for the end of the year, one of the nice things you can do if you have more than one that you're materially participating in is you can use the grouping election that's available, that we nicknamed it the -4 election, but because it's under section 1.469-4, 4G, I think. But the nice thing with that is if you get like 120 hours on the first property that you bought, and then you're only able to get like 50 or 60 hours on the second property you bought, if you use that grouping election to group the two of them together, and in the aggregate, you have like 180 hours on that pairing based on that activity, then it can allow you to claim material participation because you've got 100 hours more than anyone else on that activity grouping. So, I mean, and that's why I would say, it can be really advantageous to keep trying to materially participate in that, to where you add more flexibility to your following tax year, as far as racing to the finish line for material participation.
Okay. No, this is great talk right now. Great talk. The bourbon is starting to hit a little bit. Not gonna lie, I'm a light eater during the day, so it is starting to hit. We're gonna take a question. We're taking a question. I know Carol. I see your questions in there in the Facebook group. Don't worry, we're gonna come to you next. But this question's been patiently waiting in the box in the comment section, so we gotta take it. All right. So this one, hoping to do the 100-hour more than anybody else. Everybody loves a short-term rental loophole. I have traveled overseas to get the rental up and running and manage my own Airbnb, get my own clients. I think that's what she's referring to. I don't have
sounds like it's a foreign property again, maybe. So just in the case that person missed that, if you have property in a foreign country, it's not eligible for bonus appreciation. So that's the major drawback. But I mean, other than that, though, I mean, fact pattern there sounds okay. If you have 100 hours more than anyone else and you're not using a property manager, it's definitely viable. It's definitely possible to remotely manage. That's just the drawback of foreign property.
Okay. Okay. We're gonna take Carol's question and we're gonna circle back to another one we have about a sale. Okay. So so this is Carol's question. If I sold my house last year but couldn't get the proceeds until this year because my ex-partner wouldn't agree on the split, is there anything I could do now to 1231 proceeds or lower the capital gains?
Yeah, I the first time I read this, Tom, I thought she meant like partner, like spouse, but I think we're talking about like a business partner, like a partner in the deal.
Yeah.
But and then I think what they mean is 1031, not 1231.
Okay.
On there, and you know, whoever posed that question, if we're wrong about any of those two things, let me know. But I would say, you know, unfortunately, you're probably out of luck. But also, if we're talking about 1031 exchange, there's like more mechanics involved, where I don't want to, you know, I don't want to say that. This is the drawback of partnerships occasionally, is that it makes it really difficult when you have when you're wanting to use 1031 exchange, because if you have two partners in a legit partnership, and you go to sell the property, and partner A says, I really want to do a 1031 exchange, and partner B says, I don't, I just want to pull the cash out and I want to go buy a boat with it or something, whatever the case may be. You're not able to, as a single partner, you can't take like your chunk or your share and 1031 that into a new property of your own. When a partnership sells a property, in order to pull off a 1031 exchange, that same partnership has to be the one that buys the property. So that is one of the kind of like, here we're talking about like forgotten benefits. So this is one of those like in the shadows pitfalls to partnerships potentially, is that you can't, like, for the most part, you can't 1031 out of a partnership. There are ways to pull it off, but it takes an immense amount of planning, and it takes a long amount of time. And you have to, if you're dealing with like a partner, there's like a less than amicable type of split going on, you're probably not going to be able to get them to be patient and help you with it. But it takes 1 to 2 years to do a technique called a drop and swap, to basically 1031 out of a partnership. So it sounds like, you know, just based off of the information there, unfortunately, there wouldn't be anything that you could do.
Bummer. It happens. Look, it happens. It happens. All right. So we got some questions coming. We're gonna take this one from our Facebook group. I see everybody on YouTube. See John. I see Wes Webb. I see Joe. We're gonna take your questions next. We got this one question lingering from Facebook, so we have to take this one. When we sell rental A with a capital gain, can we unlock suspended carryover losses from property B, C, D? If so, do these unlock suspended losses can offset your W-2 income and adjust Magi? All right, so let me take it from the first part. Okay, what happens is when you sell property A and as a capital gain, you will unlock suspended carryover losses from property B, C, and D to the extent of the gain. Excuse me. So yes. If so, those unlocked passive losses, can they offset your W-2 income or just Magi? Well, they're not going to offset your W-2 income. They're just going to offset the gain on sale from property A. As for Magi,
yeah, I mean, I would say it's kind of, I don't want to say redundant, but you know, your capital gain from property A is increasing Magi, and then the losses that are being allowed to be used from B, C, D are reducing Magi. So like sort of yes, but like it kind of circles back to what Tom was saying. It's still just offsetting the capital gain for the most part.
Right. Okay, cool. I was gonna say the burn was starting to hit me right now. I was gonna have to pull out like a worksheet and start working through it. Okay. Okay. Okay, so we got this one. All right, we're gonna take one from the Instagram, not Instagram, excuse me, the YouTube. Okay. I always hear about the real estate professional way to deduct RE losses from W-2, but if your AGI is below a certain threshold, can you deduct losses to reduce your total AGI? So really interesting story. Really interesting how it works is that I know you're talking about AGI. I think what you might be referring to is modified adjusted gross income, because that's usually where this comes into play. And with modified adjusted gross income, your rental losses are actually added back to your modified adjusted gross income. So I think for the purposes of what you're referring to, it can reduce your W-2 income if you are reps, but it will be added back to Magi, unless I'm mistaken there.
Yeah, I think what they're probably talking about is the past activity loss allowance.
Okay.
So yeah, it's if your Magi is below 100,000, then you can take up to $25,000 of rental losses to offset your income. But like what Tom's like referring to is it being backed out is why it's not just AGI, why it's modified AGI is the modified portion is you would take like your you have to look at, okay, what are the losses if we like ignore the losses and see like what basically like what is your income, what's your income threshold before we take the rental losses. Now, if you're over $100,000, that $25,000 loss allowance, it starts to phase out until you get up to 150,000. And it's 50 cents for every dollar that your income is over 100,000. So like the way that works is, let's say you have $125,000 of modified adjusted gross income, then you're halfway up to the $150,000 total phase out. So half of the $25,000 allowance is reduced. So you'd only be allowed to take up to 12,500. So that's like that sliding scale that it works up to between 100,000 and 150,000. It's funny that somebody asked this question because I was just complaining to all the other advisors in the channel about how the fact that that number has been in place since 1986.
Right. It
They
hasn't
have
been
not inflation adjusted it at all, which really ticks me off because if you actually like were to inflation adjust it like they do with most other thresholds, the AGI threshold would probably be like closer to 200,000 by now, which would actually help out a lot of lower middle class investors. I jokingly said I'm going to write a letter to my congressman about that this week. So
you should everybody on this
for you guys out there.
Everybody should on this feed should write a letter to your congressman, even if you're not in that threshold. Just do it. Just send them it because it is ridiculous. And you know what also, know what also hasn't been indexed for inflation. I'll tell you, the accredited investor rules, right? Like that when that was put back into place I don't even know, frankly, off the top of my head when that was put into place, but it was a long time ago. That has not been indexed for inflation. So in other words, like to qualify as an accredited investor and invest in some types of limited partner deals like syndicates and funds, you need to have a net an income of over 200K for the last 2 years with the expectation to do it in the third year with and then that's added, you added another 100,000 for 300,000 if you're married. That has not been indexed for inflation. So sometimes there's good and bad things. I guess you have to weigh the consequences. Okay.
Absolutely.
So I think we're just going to cruise right through this with questions. Just for everybody who's listening, I just want to recap the beginning of this because I know there's new people have joined. The big topic, the big campaign that at least I've been on recently is to show people that there are tremendous tax benefits of investing in real estate besides just reps, besides just the short-term rental loophole. When you zoom out and look at real estate investing as an investment strategy over decades. And the one me and Justin covered earlier on this feed was that tax advantage income. And basically you can generate income from real estate and basically not pay taxes on it thanks to depreciation. I'm not going to recap all of that. If you want to go check that out, you can just rewind all the way to the beginning. But that was kind of the premise of part of today's Taxes in Bourbon, is just to realize that there are tax benefits of real estate, especially when you exit. We talked about the 1031 exchange a little bit, about the lazy 1031 exchange. Like reps and short-term rental loophole are really powerful if they fit into your investment strategy, your lifestyle. But the reality is not everybody's going to qualify for those things. And you should not get turned off from real estate. I am not a real estate professional. Okay. And I don't use the short-term rental loophole.
Me neither.
Right. But we both invest in real estate. I know Justin has a portfolio. I do it through limited funds, limited partnership interest right now. But the point is that they're both tax advantaged, and neither of them have to do it reps. So anyway, go back and rewind that. But we're going to continue. We're going to cruise through this with questions because we just have so many of them coming in. Thank you everybody who's joining us right now. Thank you everybody for sending the questions. If you have questions, drop them in the comments. Drop them in the feed on YouTube. We'll keep going.
Yeah, I think the next one is. Oh shoot, you already got it there. Okay. I
Yeah,
was looking at the capital gain question on there. I'm not sure where we are in the queue.
okay. Actually, we're gonna come back to your question. Yeah, we are here for the capital gains.
Yep, there we go. Cool. Yeah, this is a really good question. I saw this pop up and I was like, ooh, I can't wait till we get this one. So I've got a rental sale capital gain, but also carryover stock losses. And so it's funny. I like that this question came up because like what Tom was saying about 1031 exchanges, for example, being really advantageous is I have a lot of clients that'll have gains on something from portfolio trading, doing like stock trading and stuff like that. And that's like just a big comparison between like stock trading versus like doing real estate is, if you have gains on a major transaction that you're doing with stocks, you're going to pay taxes on it. Like there's almost no way around, avoiding that. Whereas like on the real estate side, you have the 1031 exchange that allows you to do deferrals, which is great. So anyways, jumping in here, rental sale causes a capital gain. You got a big carryover loss. So over the years, other unsold rentals have suspended losses. How does this follow through? When we sold one rental, capital gain offset with stock loss first. So the tricky thing is, the helpful thing here is that when, like I kind of alluded to before, I think in one of our earlier questions, if you have capital losses, we see this a lot when it's like stock losses or like crypto losses that are generating like large capital loss carry forwards, is you're only allowed to take $3,000 of those types of capital losses to offset your W-2 income. So it's very, very limited. But capital losses can offset capital gains. So what can happen is if you have like $50,000 or $100,000 of capital losses from like crypto or stock sales one year, you're going to get a piddly amount of $3,000 that you can actually offset your W-2 income, and all the remaining capital loss is going to carry forward into future years. But where like real estate can be helpful coming into play here is if you've got heavily appreciated real estate that you can sell for like $100,000 capital gain, for example. Well, now you have capital gains. Like I mentioned before, you can offset capital gains, capital losses. So we'll refer to this sometimes as loss harvesting, because those losses are just sitting there almost idle because you can barely take any of them. But you can basically eat into the rental capital gains to offset it with something like stock losses. So that is like one of the ways you can actually have, losses in income from these two different chunks of sources like stocks versus real estate actually interacting and helping one another. Now, as far as like the second part of this is over the years, unsold rentals that have suspended losses. How does this flow through? So, and this it kind of layers on top of what we were talking about before of, we've got two different things going on here. We have capital gains and capital losses, but we also have passive income and non-passive income. We have passive losses and passive income occurring. So what, again, mechanically is going to happen is the rental gains, say $100,000, sticking with that same example of capital gains from a rental sale, that's going to be passive income. That's going to enable up to $100,000 of passive losses to offset AGI. So what you would effectively have happen here is you would have your losses, your capital losses from stock sales are going to be able to absorb the capital gains from rental income, but simultaneously you're going to have the passive income enabling passive losses to actually flow up onto your 1040. So to like kind of answer this question the complicated way, it's not super direct, but yes, you are going to have some of these suspended passive losses that are effectively going to get unlocked and flow up towards reducing your AGI. So I think that covers the entirety of the question, hopefully. But hopefully that's not too confusing.
No, thank you. Thank you.
It makes a lot of sense when you actually see it landing on the tax return. But I know the tax return jumps from this form to that form to the other form, and that still looks kind of confusing. But
tax returns to the non-tax professional are definitely a quagmire. I feel like even some parts of some tax returns, like if you gave me an 1120, right, and a big 1120, which is a corporate tax return, by the way, like a C corp, like an Apple, I think that'd even be a quagmire for myself. I mean, like, look, like it's just crazy how complex these things are. Like, don't get me wrong. Like 1040s, easy. Now, I mean, at this point in my career, for the most part, 1040s are good. 1065s, 1120s, which are S corporations, but if you're unfamiliar with some of these tax returns, they can be daunting. So,
no. And back in 2018, when they did a massive overhaul, the entire goal was to try and get the 1040, which is 2 pages. Their entire goal with revising that was to try to get the 1040 down to 1 page. The end result was they turned it into 5 pages. Yeah.
Oh, I'll believe it when I see it, man. I'll believe it when I see it. You know, they talk
they fiddled with it and just made it worse.
They talk this big game, but yet they never come through with it. So, all right, we're gonna keep cruising through right now. We take this one. Okay. I have a short-term rental last year that we used to offset my husband's W-2 income. I managed everything myself and had an average stay of 7 days or less. Nice. That's hustle right there. For this year, I'm working on becoming a real estate professional, aka reps, for everybody out there who wants to know the acronym for that. And I got my real estate license and would like to use this short-term rental. Hold on, I got to pause for a second so I can read the actual question. Since I have people renting it for 2 weeks, 7 days, 3 to 4 days, and I managed the property myself, can I include the working hours of this property into my reps hours? Okay, this is a good one. This one, believe it or not, I actually wrote an article on this. Okay, so I'm going to summarize this for everybody, my opinion, and then the actual stance, the advisable stance. Okay. So long story short, your hours should count under the current regulations towards the real estate professional status. They should count. It's right in the regulations, 1.469-9. But, however, there are 2 tax court cases, Bailey versus Commissioner, that was 2001, and Todd and Pamela Bailey, which was 2011, that contradict that, where the tax court ruled that short-term rental hours do not count. Okay, they do not count towards the real estate professional status. So while the current regulations that were updated in 2021, okay, indicate that short-term rentals by definition should count towards the real estate professional status, 2 tax court cases contradict that point. So if you were to take that position, which I do believe there's reasonable basis to take, there's risk. There's still risk that the IRS could come in and deny your position based on the 2 tax court cases. So what am I trying to say here? If you want to be super aggressive, you want to play risk, you want to play it risky, you want to roll the dice. Yeah, go ahead and count those hours. However,
were you going to say play chicken with the IRS, Tom?
Yeah, play chicken with the IRS. That's a good way. That's not what I was going to say, but that's what you're going to say. That's the way to view it. If you want to play chicken with the IRS, yeah, go ahead and include those hours. But if you want to play it safe and you want to not have to deal with any BS, hassles, okay, might be a better way to put it. I would not count those hours. Those hours. So that's my answer. I know.
Yeah, I'll add in here too, like and this actually kind of touches on something we were talking about earlier, is that what if you don't have an average stay of 7 days or less on it, and that by the end of the year, and it's not a short-term rental, then like say your average stay is 10 days. Well, it's not a short-term rental, you're arguably not running as much of a risk in that situation as far as being able to say whether or not short-term rentals qualify for real estate professional hours, because it would actually be deemed as a long-term rental in 2023. But the other thing that's, again, still mildly risky in that situation is like what we were talking about before, is flipping a short-term rental to a long-term rental in the immediate following year, like immediately in January. Your fact pattern is a little bit more, I would say, in this question, still like a little bit more conservative, because it sounds like you've got 7 dayers, 3 dayers, 2 dayers, and stuff like that. So like it, for the most part, is geared towards being like it's a property being used on a transient basis. It, for the most part, doesn't look like you're trying to skirt the rules. But that would be, I would say, if you had to pick like a happy middle ground as far as achieving your goals with the minimal amount of risk, I would say aim for this property trying to have an average day that's greater than 7. Get a lot of 7 and 9 day bookings for people that are doing like weekend to weekend or something like that. Or if somebody wants to do a 30-day stay, like great, get those people in there.
Those are all great points. Those are great points. You should try to maybe push it towards a long-term rental, and you might be safe there. And it sounds like, based on your strategy, if you could push it to Justin's point, if you could push it to just 8 days, if you could push it to just 8 days, you're good.
Yeah.
So
what happened? I said 7.2 since we know that they care about decimal points.
Yes. Justin found some great tax court cases, by the way, that if your average stay was 7.000000001, then you blew the short-term rental loophole. So be very careful of your decimal points. Oh, ooh, I almost just knocked over my computer. Okay, too much bourbon.
As long as you don't knock over the bourbon, Tom.
The bourbon. That's how I fried my last computer, not with bourbon, but with water. I accidentally, I was about to record a podcast, right? And I had this like cup right near my desk, and I accidentally spilt it. I'm telling you, this is like 2 minutes before the podcast starts. So I pick up, I clean everything up. But when I picked up my laptop after, like the next day, there was water all under it. Fried the laptop.
No.
Fried the laptop. So for everybody who wants to know, I'm gonna say I might just save you a few bucks right here. Look, if you ever drop water on your laptop, turn it off immediately. Like stop whatever you're doing. If you want to save your laptop, turn it off and go put it like in rice or something like that, and don't touch it for like 4 days. Otherwise, if you keep it running, what's going to happen is the water is going to seep into all the circuitry, and it's going to blow your laptop. Trust me, it's happened to me twice now.
I did that with a phone a few years ago. Threw it in rice.
You have to be very careful. Okay, that was totally off topic. Okay. When you sell, this is from Craig on YouTube. When you sell a property for a large capital gain and with suspended passive losses from bonus depreciation, can you offset the carry forward passive losses against W2 active or against active W2 income?
Yeah, I mean, honestly, and I mean, we're dealing with an up market for the most part over the last 10 years. So it's just highly unlikely that you would. I mean, the gain that you're going to have from the property is going to wind up absorbing any of the suspended losses that you have going, carrying forward. I would say like the only time that you would really have like a potential for this would be if you were selling a property maybe at a loss, because when you substantially dispose of an activity, you can unlock the passive losses. It's just that unlocking the passive losses is probably going to be a moot point for most situations because you're going to have enough passive income from the gain on sale. So, I mean, that's kind of short and sweet answer, I guess, is you're probably just going to have your rental losses are going to get absorbed by the gain on sale.
All right, perfect. So DAP asked, did we answer his question yet? So you know what they say. Well, first of all, DAP is actually up next. But the hungry mouth gets fed. And there we go. So we got DAP. My name is David, and my mother has made a living will with me as a child. Oh, I'd hope so. I mean, I'm sorry. And she has willed me her home to me. Will I be taxed anyway? No. The bottom line is no. You will not be taxed on the receiving her home. That's the short and the long answer.
Yeah, unless her home is around $13 million value. It's like $12,580,000 or something for like the estate for a single estate person's exemption.
But she would be taxed. She would be taxed, not him.
Right, the estate would be taxed. Yeah.
So for everybody who's wondering, like when you inherit assets, you're not taxed when you receive the assets. You might be taxed when you sell the asset if the sales price when you sell it is higher than the fair market value on the date that you received it. Okay, or we're gonna go into trust law and trust taxes, but we're not doing that tonight.
Yeah. It's best to have an appraisal done. And it's a very morbid kind of situation to deal with this as soon as she passes away and the property transfers to you. You want to have an appraisal done on it relatively quickly to determine what the fair market value was of the property at the date of death. That comes into play, like what Tom is saying. If you were to sell the property like a year later, you need to know what the value was when you inherited it, because that will come into play when you go to sell the property later.
Absolutely. Okay, we're going to keep going here. Okay. I don't know. This person asked, does this also apply? This Facebook, I'm not going to post this here, but yeah, this person asked, does this also apply if there's material participation and not rep? So if you materially, okay, I know where this is from. If you materially participate in your short-term rental, right, and you don't, then your short-term rental will be considered non-passive, even if the hours don't count towards reps. Okay, so you could separate them out, bifurcate them if you want to be safe.
Yeah, you could be a real estate professional and have long-term rentals, and you could also do the short-term rental loophole. You have to kind of silo them as two separate situations.
Well, actually, I think they might have posted this too. Average is now 7.25. Well, guess what? If it averages 0.72.25, you just made it into a long-term rental territory. Congratulations! It's just like you accidentally stopped. It's like you're going over state lines and you accidentally stopped, and the nose of your car is just over like the state line. Oh, congratulations! Welcome to Texas. Right? I'm just making. Okay. See, this is the bourbon starts to hit. You could tell in these taxes in bourbon when the bourbon starts to hit. Okay. Because
I have a high metabolism or something, so it doesn't hit me as much, I guess. I don't know
you know what it is, guys. So I'll level with you guys, and this is when I start getting real on these podcast on these taxes and bourbon, right? I've been following the keto diet for so long that I don't eat real food until dinner time, and I've not eaten dinner today. So I eat like protein shakes. So I literally liquid diet up until right now.
Those rice cakes aren't doing anything for you, Tom.
Those rice cakes. All right, so we got this one. Is this session recorded and posted on YouTube or Facebook group? We got you again. It is. Well, the answer to the question is yes on both accounts. It is live to you. You can always watch again. Which, by the way, if you're not subscribed to the Tax Smart Investors YouTube, go to YouTube, type in Tax Smart Investors, and you'll be able to find us. Go ahead and subscribe because we do actually drop YouTube videos, believe it or not. And then also, if you're not in our Facebook group, if you're watching this on YouTube, go to www.taxsmartinvestors.com/Facebook, and you could join the Facebook group where great stuff is always happening. Conversations about how to reduce taxes, Q&A. It's phenomenal. Trust me. It's free. Join. Okay, yeah. We're gonna take a few more calls. We're coming up on the hour here. And for anybody who's new, if you're watching this right now and you think this guy's a little loopy, I just drank some bourbon, so I hope you hope that makes sense. Okay, here we go.
Don't worry, I'm here to fact check Tom. It's fine.
Fact check him. Okay, here we go. We got have any service provider recommendations for setting up an STR trust and a Wyoming LLC? I can't. It's hard to recommend attorneys, and not that we don't have any recommendations. We certainly do. But what I've found is it's very how am I trying to say this? There's a lot of opinions out there about what you should do and shouldn't do. So I would suggest here's what I would suggest. Ask some of your real estate investing buddies who they recommend. If you're in a group or if you're in a group, ask them who they recommend. If you're not in a group, find a group. And there's plenty of them on Facebook, and ask who they would recommend. The reason why I say that is because what I found, and this is true of professional services and even stuff that's not so professional. So me and my brother and my sister were looking for recommendations for Italian restaurants. What I realized was I go on Yelp and find a million Italian restaurant reviews. But if my neighbor was to say, hey, Tom, by the way, this restaurant's really good, check out that restaurant, that would carry so much more weight.
It's true.
That carries so much more weight. So what does Italian restaurants have to do with Wyoming LLCs? Find good referrals for people who've used good attorneys before to set up their Wyoming LLC, and there you'll have your answers.
Mm-hmm. And I would also just I think a big thing when you're interviewing any service professional is ask a lot of questions. If they say they tell you do Nevada instead of Wyoming, ask why. What's the legal reason why? Oh, okay, great. You've had better experience with Nevada. How many clients have you represented in cases where Nevada came into play better than Wyoming? Ask them some of those questions. If they're like, oh, we've never had to represent anybody, we just always set them up that way. Well, maybe that's, telling you something. So I would ask some of those, just try to think of some good qualifying questions, and don't be afraid to ask why. I think we see this in our community as well with tax professionals, is people are afraid to, I don't want to say it's not like you're arguing or challenging. It's just, hey, I would like to know more. I'd like to know what the reasoning is. And of course we're really big on that because we like to cite everything. Aren't just going to say our opinion is blank, like there's going to be a reasoning behind it, like whether it's a code section, treasury reg, a revenue procedure, a tax court case, like something like that. And if you can find as, professional, like a lawyer that's going to be able to say like, yeah, we've represented clients in cases where XYZ, occurred. This is why the Wyoming LLC was, assisted with that. Even better. That's the best advice we could give you on like trying to find a professional for that.
Great points. Great points. All right, so we're coming up. We have about 5 minutes left in the hour. We're gonna take a few more questions. We're probably gonna finish this off here. If you do have any final questions, just drop them in here. We may have time to take them. If not, we'll keep that in mind for future reference.
Did you see the one about Massachusetts and New Jersey? I think that's the next one in the queue.
Massachusetts and New Jersey sounds.
Yeah, 7:40 Eastern is the timestamp on it.
Okay, let's go ahead and take that one. Okay. Can you get short-term rental benefits if you self-manage remotely? Short answer to that question is yes. Okay. I'm interested in a property in Massachusetts for primarily summer rentals, but I live in New Jersey. Okay. Not too bad. Not too bad. New Jersey is actually pretty close to Massachusetts if you look at it, the bigger picture, right? If you want to drive there, but anyway, if I were to pursue this route, would like the tax benefits, what's the best approach? The best approach. We're getting to operations here. We're getting to operations.
Yeah. It's definitely viable, like you said. I mean, you can definitely do it. I mean, we have clients that, live in, live in Arkansas, and they're managing short-term rentals down in Gulf Shores, Alabama, and stuff like that. Like it's definitely possible to do it remotely. I think, most people that are successful with it will tell you like it's key to have like a good team in place. And by team, I mean, like you've got a good cleaner, you've got a good handyman that's local, like that kind of stuff. But short-term rentals are pretty heavy on the ongoing management side of things as far as like tenant communications and, just like ongoing correspondence and stuff. So, yeah, I mean, it's definitely viable. And I'm obviously, like Tom said, I mean, in your case, like New England, I mean, those are pretty close locations. I was just talking to a client this morning about who lives in New Jersey. And, he was talking about properties he might do in New York, so, I mean, it was like a 6-hour drive, but it's definitely doable. The main thing is just making sure that you're tracking other people's time, because in order to substantiate that 100 hours more than any other individual, you've got to track the other people's time that are involved on the property. And really, it's probably going to be your cleaners are going to be the biggest threat to that material participation test.
Yeah, the cleaners, you got to watch out for the cleaners. Some ways people get around the cleaners is hiring multiple cleaning companies, hiring multiple cleaners. But yeah, the cleaners definitely got to track their time, make sure that they're spending less time than you, for sure.
Yep.
Okay.
Get a remote door lock system that has some kind of tracking system on it.
Okay, so we're going to go ahead. We're going to take a few more here. We got a few more left, and that's it. So we got, can you walk, this is actually a unique question that we got tonight. Okay. Can you walk through acquiring a Tahoe or Suburban from my investment company and possibly offsetting capital gains? This is okay. So I'm not going to look this up right now, but I'm going to assume a Tahoe and Suburban have a gross vehicle weight rating of over 6,000 pounds, because I believe they do.
Mm-hmm.
So the way this works is if you use this vehicle more than 50% for business, okay, more than 50%, then you're able to use the actual expense method. And what the actual expense method allows you to do is claim depreciation, specifically bonus depreciation, on this Suburban or Tahoe. And so say you used it 75% for business, just to give you an example. Let's say the Tahoe or the Suburban cost $50,000. I'm just pulling a number literally out of a hat right now.
I've been looking at them; they're like $90,000. So.
Okay. Oh, okay. I'm way off base. Look, I haven't went car. I'm driving a 2003.
Freaking inflation, man! It's killer.
I'm driving a 2003 Lexus that got handed to me. It's probably worth $3,000, but I love the car. It drives so smooth. Anyway, so the $90,000 Tahoe has nothing to do with my Lexus, but $90,000 Tahoe, say you use it 75% for business, $67,500 to be eligible for bonus depreciation. If you could take 80% bonus depreciation in 2023, you'd be able to get a $54,000 deduction. Mind you, if you use it 100% for business, you get $90,000 eligible for bonus depreciation, and 80% of that would be Jeez.
72.
That's good math. Good mental math. So how can it offset capital gains? How can it offset? It depends on what type of capital gains. Okay, and it depends on, are you active or passive in the associated business? And I assume it's a real estate related business. If you're active, so you have reps or you're using a short-term rental loophole, right? Then you can offset virtually any type of capital gains, because the losses from that Tahoe would be non-passive. However, if it's passive, you don't have reps, you're not using the short-term rental loophole, then the capital gains would have to be from rental real estate in that case. Am I missing anything there? Is the bourbon hitting me too hard, Justin?
No, I totally agree.
Okay, good. I'm good. Okay, here we go. We're gonna get these last two questions. Are you good to we get these last two questions? We call it a wrap, Justin?
Yeah, totally.
All right, cool. Why are you calling anything over 7 days a long term? For depreciation purposes, anything less than 30 days because it's short term, depreciate over 39 years.
Excellent question. I think that's coming from a CPA.
It must be. Sounds like it. Okay.
So, yeah, can I take that one?
Yeah, go for it.
So it's another one of those just like terminology type things too that it's funny, we were just talking about this earlier this week in the firm. So what we're really talking about is like kind of two different things. We're talking about short-term rentals as far as that term being the exception to the passive activity loss rules, right? So we're talking about Section 469, Treasury regulations under 1.469-1T and stuff like that. Now, when we're talking about like how is a property actually depreciated for like 27.5 year versus 39 year, we're looking at a different set of rules, a different code section. We're looking at Section 168. Section 168 is going to say that a property is considered to be non-residential. I love the way that the IRS words everything. It's always in like a negative. But they say that a non-residential property is anything that's not residential. Well, essentially a residential property is a property that's used on a non-transient basis. So that's going to be a property that's used for 30 days or more on an average period of customer use is 30 days or more. And that's actually expanded on in a private letter ruling. I believe is actually where that's addressed. I forget what it's 2007-932, something like that. I have to pull it up. But essentially, if a property is being used on a transient basis, which transient basis being that it's used on an average period less than 30 days, then it's considered to be non-residential. So non-residential being the designation that actually makes a property depreciated over 39 years, and residential being a property that is 27.5 years. Now, that's just one of the exceptions. Obviously, if you have a property that's being used commercially, that's clearly going to be non-residential. It's just that they added to the code section to say that if you have a property that is seemingly residential, like short-term rental, and this is the funny thing we get into a client sometimes, they're like, wait a minute, why is my property non-residential? People stay the night there. How is that not residential? Well, it's because of this goofy rule that they have that says if it's being used on a transient basis, it's going to be treated as non-residential. So what we're talking about is, if you have an average period of customer use of 10 days, it is a non-residential property, but it's a long-term rental for purposes of material participation and things like Section 469. So I think that kind of covers all the ins and outs, but try not to go too fast.
Yeah, no, that's very good. And look, if you're CPA, you're an EA out there, you're a tax professional. We did do CPEs on Stratford, I believe, on all these topics. So go check those out in Stratford. Shout out to Stratford. Stratford just got a shout out. Stratford has a very good business model, by the way. But anyway, I'm not going into that today. We're gonna take this last question from Marcella on YouTube. Thank you for the question, and thank you for everybody who's tuning in right now. Before we wrap up, I have a quick little blurb, but we'll go ahead and wrap up after this question. I lived in my house for the first 6 months of this year and converted into a short-term rental in June. I manage it myself and have an average stay of 7 days or less. Can I use the tax loophole? Yes. Yes.
Yeah. The like restriction that could come into play would be like personal use regulations, but based off of
With the
our understanding there is those kick in once the property becomes a rental. But up until that point, it wasn't a rental property, so like the actual personal use days aren't going to kick in that situation.
Right. That's yeah. Long story short, yeah. Okay. So thank you everybody for tuning in for this Taxes and Bourbon. We do Taxes and Bourbon every month, or just about every month. Sometimes there's some months where like we don't, but most months we do. So if you want to join the Facebook group where all this goes down, www.taxsmartinvestors.com/Facebook for anybody who's watching on YouTube. And also want to let everybody know that we are hosting a QBO boot camp where you'll basically learn how to set up a QBO accounting system for your rental properties in about 2 weeks. It's kicking off October 9th. You could learn more if you want to join it, www.taxsmartinvestors.com/bookkeeping. And you can use the code October if you do want to get 50% off. The only reason I'm mentioning this tonight is because I know it's going to happen. October 10th. October 10th. It happens every single time we do this. October 10th, so I'm going to get a flood of like 10 messages from Facebook, from email. I missed the deadline. Can I still get into the QBO bootcamp? It happens every single time. So I'm just letting everybody know that it's going down. It's starting October 9th. www.taxsmartinvestors.com/bookkeeping. Use the code October to get 50% off. And this is probably probably going to be the last one we're running of the year. If I'd say probably, I'd say like 90% probably the last one we're running of the year. It's just not going to fit into the calendar. So we'll probably do another one in January. So if you want to get it in before the year end, that's how you do it. Love to see you there. And that's it for this episode of Tax and Bourbon. As you can see, I finished off my Horse Soldier bourbon today. It's gone. It's done. I think there might be a little dribble left. Justin,
I made a dent, you know.
Made a dent. So we're gonna be back, and next time I'm gonna crack open my four seasons. I think that's what it's called.
4 roses, right?
4 roses.
Yeah,
4 roses.
Yeah. They broke the cork off in.
Yeah, the cork broke off that one. So whatever. What are you gonna do? Justin, thank you so much.
Too long.
This one I had for like 2 years. This one I had since like 2021. Whatever. Thank you everybody for tuning in. I hope you understand that the bourbon's hitting pretty hard right now. Justin, thank you so much for joining us tonight. And so we'll see you on the next Taxes and Bourbon. Have a good one. I'm back, and I'll let you guys know that it would keep running vacantly if I didn't shut this thing down right now. I thought by exiting the browser, just shut it down and not